Next up, we have financial analysis of the current budget presentation by David Cain. Welcome back. Oh, Ryan Smith. Okay, sorry.
So, good evening, Mayor and Council. I'm going to start off. This is going to be another team presentation.
Okay.
I'm going to kind of start off with the 20-year analysis and the changes in the 20-year analysis from the February numbers that went to the HH committee and the numbers that came with the proposed budget in June. So those are the two forecasts that I'm going to first start with comparison, and then David's going to kind of get into the work that he did in analyzing the 20-year model that we have today and what that looks like going forward. So to begin, I started with the 20-year model that was presented in February to the HH committee, and I compared that to the most recent model that went with the 22-23 budget. Between those two models, we had a fund balance, an ending fund balance that decreased by about 70 million, and that's over the 20-year period. So how did we get to that $70 million decrease? So first, the revenues between the two models increased by 77 million over that 20-year period. That's mostly from property tax increases of 29 million. Sales tax and Measure HH revenue increased by 15 million and 4.7 million over that time. And advertising revenue increased by 15 million. So that's a majority of the 77 million of the revenues that increase. Expenditures between the two models increased also by 147 million over the 20 years. And that's really split into three different areas. First, the personnel expenditures increased by 51 million during the 20 years. And that's due to changes last year and this year with the new MOUs and positional changes. And those changes to those years, which are considered our base years for the model, increase, going forward through those. Those increases are compounded by a factor every year. And that gets us up to a $51 million difference over the 20 years. Operating expenditures increased by 84 million, and that's really due to a variety of service contracts that the city is in that have increased over the last couple of years, mostly due to higher costs for our vendors. And then finally, internal service charges increased by 11 million over that 20-year period. And so that's really where the $70 million difference between the two models came from. And with that, I'm going to turn it over to David, who's going to talk more about the current model that we have and the work that he's done analyzing it.
Quick question for you.
Sure.
The advertising revenue, 15 million, where is that just the one billboard?
Right. I believe that was the one proposed billboard that has been approved, I believe, last month.
And that's only 15 million, or that's a 15 million increase over what we were expecting in the original?
I believe for this 20-year period, it's 15 million. I think the actual.
So it's 700 and, what is it? What's my math? 750,000 a year?
Right. Yep.
Okay. And then the following 20 years, we expect that to go up even more.
Right. Yep.
Okay, I'm with you.
Yep.
Thank you.
Have David come up and finish.
Thank you. Good evening, Mayor and City Council members. I appreciate being back here. It's been about 5 years since I stood up here, but appreciate the opportunity to spend some time here. This is a little bit of my background for those that may not know. I did retire from Fountain Valley, but I spent about 28 years in the public sector. Probably one of my more challenging projects was the bankruptcy in the city of San Bernardino, and working through some of those challenges. I wasn't able to stay through the whole time period. It took them about 5 years to get out of there. Been actively involved even in retirement, either as an interim finance director or doing consulting work out there. I continue to teach in the public sector. And occasionally I put on my private sector hat, and having run my own company for a good number of years, long before I got into the government sector. But you guys are really here to look at the long-range financial plan. And so we're going to look at it from the perspective of looking a little bit at the history, looking at where we're currently at, and then looking at the future down the road. And as many of you are aware, we recognized that, as you know, with Fountain Valley, we had a long-range plan in place even when I walked in the door. But as we began to put those together and evaluate the numbers, we realized that although we had done a lot of cutbacks, we had not given employees salary increases for over 10 years, we were at a crossroads. We needed to make a change. We knew that long-range sustainability wasn't going to happen in the organization unless we did something differently. And so we'll talk a little bit about what that looks like. We'll look at the present in terms of looking at the both the 21-22 fiscal year, which is now complete, and so we have unaudited numbers there, and then also looking at the projections for the 22-23 budget year, and then kind of looking down the road into the future. Ran across this quote, and as I read it, I realized that Fountain Valley didn't fall into that quote. We had a plan. We knew where we were going to be going. We knew what we wanted to do as a community, and we've been executing that plan as we go down. And utilizing that 20-year plan to be able to do that is really, really important. There was a commitment from this community, from the residents, obviously, with the commitment once the decision was made to go with a sales tax measure that had a 20-year sunset on it, getting community members involved in making that happen and getting it successfully passed. When we had originally looked at it and proposed it and did a survey in the community, it was within the margin of error that it would even pass. At the end of the day, it ended up being just shy of 60% of the voters that got behind this important measure and gave us a continued opportunity for discussions and being able to take action as we move forward in this community. You may recall this chart that I used that said, hey, if we do nothing, we're going to be upside down. We're going to be out of our $30 million worth of cash in a very short period of time. And if we looked at a revenue enhancement, we would be in a much different position. So we recognized where we were at. Out of that came the Measure HH, which was titled Essential City Services, and City Council adopted a responsible spending pledge. We identified what those priorities were to be able to maintain and restore city services out there, because we recognized to balance the budget, at least in the short term, not in the long run, you know, we were going to have to close down some significant city services out there, and we didn't want to have to go down that path. So by putting that spending pledge in place also gave us some guidelines there and allowed us to be able to go into the community and start to restore those essential services on a go-forward basis. Out of that also came an advisory committee made up of a variety of individuals in the community, both those that voted for as well as against the sales tax measure serve on that committee, as well as a representative from the business community, I'll say the senior group. It was important to recognize them also, and then somebody at large out there. So that committee is a committed group of individuals that are passionate about what they're doing. What I'm excited to see at the end of 5 years since this went into play is when many communities have a citizens group put together the first couple of years, there's a lot of enthusiasm, a lot of involvement, and then it kind of wanes and drops off. In Fountain Valley, that's not been the case. They've continued to stay involved and are committed to making things happen out there, and I think that's really a testament to this community and the fact that they're committed to ensuring that the 20-year plan continues to move forward and that the spending pledge and the methodology and the accountability continues to go forward also. So as we look at the present and where we're currently at, again, knowing where we're at does make all the difference in the world in terms of understanding what's been happening. This community and the Measure HH Committee have worked together to rebuild our reserves, to go in and allow city services to continue to go forward and to carefully plan and look at the pay down of the pension obligation bonds as well as the unfunded liability that we have with CalPERS on both our safety and our miscellaneous plans out there. As you guys are aware, you heard from Dan at the last city council meeting where he talked about PERS and where it's going. We have a mortgage payment with that unfunded liability. Unlike our typical mortgages that are the same dollar amount every month, our actuarial numbers go up before they go down. And so just recognize then that costs are going to go up over time. I think one of the other things to consider as you're looking at the long-range plan is, and we recognized when we'd originally put it together, we were going to be $5 million upside down when the Measure HH was going to sunset. And so we knew that we needed to start planning for that time period. And what the plan really allows you to do when you may have negative numbers in those out years out there is being able to now address those, whether that's through economic development, whether it's through the implementation of the crossings project, whether it's infill projects, whether it's other revenue streams that we have the opportunity to take advantage of that are go forward revenue streams, knowing that our ultimate goal is to be in a solid financial position when the Measure HH sunsets. And again, acknowledging, as I've talked about, that pension costs are going to continue to go up over time. So this was another chart that we used at the time that we talked about Measure HH. At the time, we were spending about $6.2 million in our annual pension costs in the general fund, and we knew ultimately that that would go up to about $13.6 million. You look at this chart and its upward thrust that it's going, and you look at 22, 23, we're about on par with actual costs as it relates to that chart. So part of our challenge that we look at in that 20-year plan, yes.
And can you explain this cost again? Is the blue, is that what we thought the line was going to be, and the orange is what we're actually experiencing? Or
So
what?
the orange line was the current cost before CalPERS had come in and started making actuarial assumption changes, as well as the fact that once PEPRA was created, as Dan talked about, then that created an unfunded liability that was going to have to be paid off over time.
So the orange is what we were projecting back in 2016, 17, is that?
To the extent that it was our normal cost, we were just now beginning to see at that point in time our increase in the unfunded liability in our classic plans.
So the blue line is we thought we were going to be in orange and we're actually at blue?
We are in the blue, and we knew we were going to be in the blue.
Okay.
Yes.
Thanks.
So, and we are in the blue at this point. And I guess what I'm trying to say here is we knew it would go up before it came back down. Because at some point, that unfunded liability will be paid off. As Dan talked about on November 1st, we have a greater number of PEPRA employees. And so as those individuals come on board in the organization, we have a much lower cost related to those individuals.
So the orange line is the normal cost, and the difference is the unfunded?
Is the unfunded as well as other CalPERS actuarial changes, because at the time they were assuming 7.5%, they've now dropped to 6.8. anytime there is an assumption rate difference like that, the difference gets made up by the employer.
Okay, all right, thanks.
So just as a reminder to all of us, you know, Measure HH was not a windfall of money out there. It was designated for very specific purposes. We also knew that we needed to plan in the long run what we were going to do once Measure HH went away. And so that 20-year plan really gives us the roadmap as it relates to that. So part of the challenge with forecasting, and I love this quote, is it's very difficult, especially when you're trying to forecast the future, and what does that look like? And how do we go about making our best estimates of what that's going to look like down the road? It's also a tool that a lot of agencies now are implementing. Back when I first got started in finance, we did maybe a 1-2 year budget. We might have gone out a year or two with expenditures. Nobody was really doing a 5, 10, 15, 20-year plan. I really learned to appreciate the 20-year plan, both being here, but also to get out of bankruptcy. The bottom line is you've got to have a 20-year plan in place for the bankruptcy judge to be able to approve. And so being able to run those numbers and have that information is really essential out there. It also allows us, as I've indicated, to address some of the challenges that may be out there later down the road. And it allows us different perspectives, different assumptions, depending on what assumption you're making. You know, do we put, you know, recessions in there? What do those look like? We're, you know, all experiencing the cost of inflation these days. And as I'll talk in a minute or two about 22, 23, that's hit a cost of a lot of our contracts out there and has increased city costs out there. It allows us to also make internal, external changes to processes out there to be able to adjust to that plan out there. What it's not is an unchangeable plan with a set of numbers that's set in stone or granite. One of the things that Ryan and I have talked about, and as he moves forward, is with a long-range plan and looking at a different version, what happened between version 1 and version 2. And so clearly identifying what those look like in the long run. So we were asked to look at the 21-22 estimated actuals. Now that all the journal entries were put in place, also to look at and validate the 22-23 budget. We've had the opportunity to meet with the Measure HH committee on 2 different occasions, and then had some one-on-one discussions with them also, and then, of course, coming before this body to kind of give you a high-level overview in terms of where we're at. So part of the plan is identifying and being able to track and validate assumptions out there. We don't always know, you know, from one individual to another why they may do certain things. I try to document as much as I can what my assumptions are and why they're there. When we look at sales tax, property tax, we have HDL, who is a consulting firm that has been providing this information to cities and counties here in California, as well as now across the United States. And they're very good at providing us with really solid, good data that we can use. And so we're updating that model on a regular basis because of that information that's going in there. Some of the challenges that, you know, we run into, not just in this organization, it seems to be across the board with government agencies out there, is the loss of key staff and staff turnover. As an example, I was supposed to do a short 6-month interim job in Claremont. It ended up being a year because we went through hundreds of applications, multiple interviews, to be able to ultimately find somebody that they wanted to be able to have work in the organization. They finally found somebody, but it took a lot longer to do that. So part of the challenges that we're dealing with is getting good people. The second thing is keeping good people. Staff's been also tasked with implementing a new finance system. For those that have never been through one, it's a challenge. I've been through a good number of them. I remember coming to Fountain Valley and going, hey, we're going to need to do an implementation. And I said, can you wait until I leave? And they did. So it takes a lot of work. It takes a lot of effort. So closing out the 21-22 fiscal year took a little bit more time because they were focusing on getting that implementation in place. But those numbers are now in. So as we look at 21-22, there was a mid-year revision of those numbers. And the bottom line is that when you look at revenues and expenditures, the city falls within a couple $100,000 on each. So within $300,000, I believe, on the revenue and about $200,000 on the expenditures. So when we look at about $77.1 million in revenue, $63.5 in expenditures, keep in mind that for 21-22, part of that revenue is one-time ARPA money of $7.9 million. One-time money, this body approved back in February, utilizing it for public safety related cost. And so that is as part of the cost side of the equation, but that's one-time revenue, recognizing that that revenue is not going to continue to go forward. When you look at taking that ARPA money out from a revenue perspective, then you end up with a surplus of about $5.7 million for the 21-22 fiscal year. Those are unaudited numbers. The auditor is working on the audit. That typically gets done in December and brought back to this body the beginning of the year. Moving to and looking at the 22-23 budget document, what I looked at, and one of the things that we also did is we brought David Cain back to help to look at that model, because he was one of the architects of the original model when he and I worked together here. And so he went back and got a hold of the most recent MOUs, the salary schedules that had been adopted and approved by this body over the January. Actually, I think the final plan MOU was ratified in September. So looked at those numbers and compared them to what was in there. We came fairly close to the numbers that were being proposed in there, because there is about $34 million in personnel-related costs. When you look at the revenue side and compare it against the prior year, there's about $3.8 million in additional revenue for 22-23 over 21-22, excluding ARPA money. In other words, this is ongoing revenue that's coming in, property tax, sales tax, some grant money that is also anticipated in the 22-23 year. On the expenditure side, and this goes back to what Ryan was talking about, is there's about $8.3 million in increased costs. So those include salary adjustments. They also include the class and comp study. They also include the special pay adjustments. They include a couple of new positions. They also include, because of some of that implementation, FSLA requirements come into play in terms of overtime, so there is an impact in that particular area. And so looking at those numbers, we were able to validate those. The internal service funds increased by about 1.9 million. The internal service funds, as you may recall, include IT and building and vehicles, those types of entities out there, and that was, again, an increase in cost of equipment, materials, supplies. When we looked at the operating cost, it also went up by about 1.9 million. About 400,000 of that is the homeless program that this community has engaged in. There are some other one-time projects that are included in there, as well as some significant cost increase due to inflation-related costs. And then CalPERS, both the unfunded liability and the normal cost. And again, this ties back to salary adjustments, is about a $1.1 million increase in costs. So I am aware that when those were initially talked about, staff did meet with council on a one-on-one basis to go over those numbers. We have validated those numbers. And as Ryan talked about, once you plug those numbers in there, then as you compound those out all 20 years, it has a significant impact on what those future numbers end up looking like. We also looked at some of the assumptions as it related to some of the revenue streams out there, and I know that in the out years there was a desire to try and reflect historically what has happened on property tax. I don't know that that necessarily will hold true on a go-forward basis. I've had conversations with HDL about those numbers specifically, and one of the things that this body needs to keep in mind is that 4% growth that was there historically. It goes back to Proposition 13 and its implementation. So between then and now, about 80 to 82% of your properties have changed over from Prop 13 to, have resold. You've still got about 18% of your residential homes that are still pre-Prop 13. So keep in mind, those are the only ones that are going to change over in terms of an increase in value, because when they change over, they go to it's Prop 13 resets it at the market value. The second thing is that on existing property, you can only go up to a maximum of 2% a year. So even though CPI may be 8.1, property tax is going to be capped at that 2%. 2 years ago, it was 1.3. We're assuming that, you've got a 2% growth in there. So we'll typically put a 2% growth in there with a little bit of a factor as it relates to property turnover. But those out years will tend to be a little optimistic. You want to look at those and continue to have discussions as it relates to that. So as we look at moving forward and looking at the future and where we're heading, and recognizing that our ultimate goal is to have an organization that is financially stable even when Measure HH goes away, we're recommending a couple of things. One is that there be a joint workshop between this body and the Measure HH committee after the beginning of the year, when the new council member has been seated, when this body has chosen the rotation of members for that committee, so that there can be a dialogue and a discussion. Being able to look at and have this group understand what's the methodology that they have been using historically. And in our discussion in our meeting that we had this last week, they liked the methodology. They would like to continue to use it going forward. I think there are some refinements that we have discussed, and Ryan has presented to them some ideas to make that even better. But being able to have that discussion, and then also understanding the impact of policy decisions that are made by this body and how that impacts that that plan on a regular ongoing basis. I would also encourage, anytime you get new members or you have a new council member, is again, re-meeting again, because one of the things that I think many of you may have experienced is government accounting. And so trying to get up to speed on what that is. So when I originally put a binder together for the Measure HH committee, I put some basic information in there to get the committee members to understand that we operate under many different buckets of money. And we have some that are restricted, some that are not restricted. And how does that all work at the end of the day? What's discretionary and what's not, so on and so forth. So being able to have that understanding in terms of knowing and simplifying the financial picture at the end of the day. The other thing is that we recognize that currently right now, any overage of Measure HH money goes into a reserve account. So when Jason was here, this body again adopted a formal policy as it relates to the OPEB trust, the pension reserves, the emergency reserves, something called capital reserves. And so what's been happening historically is with any excess HH money over and above what was required to cover the deficit is being dumped into that larger bucket called capital reserves. So there's really a desire and a need to break that out as a separate line so that it's clearly identified. This is your capital projects. This is what we're doing. Here's the list of the projects. And oh, by the way, Measure HH is going to cover these specific ones. And then the other monies are clearly identified to be able to have a discussion both with the committee and them coming back to this body with recommendations, and also discussions with the community out there. But there also needs to be some of that money reserved, because I showed you earlier, our costs are going to go up before they begin to come back down. So you want to have some of that cash sitting there to be able to cover that. And then one of the things that happens with the plan for Measure HH is when the budget's adopted, we update it with the budgeted numbers. That's a projection, just like a 20-year plan is a projection. The most important meeting that Measure HH has is once we have the audited financial information, we then go back and revisit that sheet. And we make modifications and adjustments to it based on what actually happened. So that still needs to happen for the 21-22 budget year. Now that we have the unaudited numbers, we'll wait for the audit. My recommendation is, when you look at the 20-year plan itself, that when you go to update it and you publish it, you do it after the audited financials have been done. And I recommend in February, you need to give staff a little bit of time to finish the audit and then be able to move into updating that plan. And then the second time is after the budget has been adopted. So sometime in August, updating at that point, and then being able to track what happens between those two specific points. And then, like I said, is the Measure HH committee's evaluation of looking at the money that they're utilizing and truing that up once the audit period has been completed. As it relates to the long-range financial plan, keep in mind, it's like we define it sometimes, living, breathing planning document. It's going to change. The published one we'll have out 2 times a year, but we use it internally in the organization when we get an HDL update. I'm used to going in and updating it and see what potentially that impact is. If there's a policy decision coming down, what's that impact going to be out there? working with another organization where they've got a lot of new development going on, and what does that impact look like in terms of that long-range plan out there. So having Ryan's ability to update that on a regular basis for internal use, internal discussions, and then making that formal adoption 2 times a year. And again, keep in mind, one of the things that we recognized when we put the first plan together is we were going to have negative numbers when this thing sunset. And we knew that we needed to work on solving those problems between now and then. So at the end of the day, I think we're moving forward. The numbers are good numbers that are in there. Ryan's going to be looking at, looking at the out years, because at this point in time, when you look at the future years, it's just a percentage of 22, 23. We know based on the MOUs that are now in place that we have numbers for the next 2 years. And so those can be updated with that information out there. So again, the organization, I think, is continuing to move forward. They've accomplished a lot of things over the last 5 years. And you've got 15 years out there to continue to create it and make it happen going forward. So with that, that's the information that I've got. And we're open to any feedback, comments, or questions.
Thank you. Any questions, comments from the council? Councilor Grandis?
I think we have some blue cards. Should we go to the blue cards?
For the study session? Okay, all right.
Yeah, we have 2 requests to speak.
Okay, all right, let's hear the speakers, I guess.
Evan Jorgensen.
Hello, my name's Evan Jorgensen. I was on the Measure HH committee in the calendar years 2019, 20, and 21. When we were on that committee, we were being told everything was going smoothly. Yes, we started out with a negative budget or balance in 2037 when HH was supposed to sunset. But by 2020, 2021, it was positive. Okay? And now we're going to be down $70 million. I don't think it could be attributed to one thing or another, but we asked whether the payroll had significant increases in it. We were told yes. Whether the operating expenses had cost of living increases, we're told yes. Mr. Cain was saying that Prop 13 is only going to, when somebody sells a house that was bought before Prop 13, that's the only time you're going to increase property sales tax. That's not true. Anytime you bought a house that is now less than market value, when you sell that house, you're going to get an increase in property tax. It gets readjusted. It's not forced onto that 2% per year. And that's, you're probably 50% or more of your sales are going to increase the assessed valuation of your house, if not more. When David Cain was talking about, he quoted Niels Bohr on forecasting. Niels Bohr was forecasting the location of an electron on the atomic level. This is difficult to see, and it moves extremely, extremely fast. Forecasting on the city level shouldn't be that difficult. You have 65 years of history here. You shouldn't have to change this much in 1 year. And again, on what I'm looking at, the responsible spending pledge, it says we were supposed to pay down liabilities, pay down the unfunded, and pay down other debts, then to rebuild the accounts. Okay, you continue to put the money in the capital reserves accounts, and I've heard talk in other study sessions of a $90 million rebuild of City Hall. I've heard in council meetings where people on the council are suggesting that we fund a building project reserve account. No, this should be going towards the paying down the debt or going into reserve accounts to pay down the debt.
Okay. Thank you.
Matt Taylor?
Good evening. My name is Matt Taylor, and I have been on the HH committee since its inception, as well as the chair of the Yes on HH committee. I guess I want to start with just an extreme level of frustration over the last year and a half of trying to understand what happened. You heard David Cain tell you tonight that when we started, we had a deficit, and when Measure HH expired, and our goal was to close that gap. I want you all to remember that the report you were given back in February at the midterm report showed that we closed that gap, and not only closed that gap, but had millions in surpluses every year. We achieved our goal. We achieved it in April of 2022. And between April 2022 and June 2022, City Council authorized an increase in $170 million in spending. That's what Ryan just told you. $170 million in increased spending in 3 months. And then you turned around a month later and started crying poor. We're running out of money. We're running out of money. And the HH committee was like, what are you talking about? We saw a midterm report that showed millions in surpluses. Oh, City Council spent that already. That was not clear to the public. That was not transparent. And now to hear us all claim that we need money falls on deaf ears because you misspent the money we had already raised for you. And that has been the claim that Measure HH has made in our letter to City Council for the last 2 years and have been ignored in both of those letters. I appreciate that David is recommending that we meet on a regular basis. I appreciate that he's recommending separate line items to recognize those HH funds. But I want to tell you, just because I'm the guy that I feel like was in many of these homes when we were trying to get HH passed, I do honestly feel like you've made me a liar. I promised families that we would be sensible with this funding and with this money. And as soon as we got a budget surplus, as soon as it looked like we had a lot of money, we forgot about the spending pledge. We forgot about what that money was there for and what we asked the voters to do. And I stood in their homes and told them we wouldn't do that. And I don't feel like we've been honored to that promise. And I haven't been able to enact that as being part of this committee. I'm hopeful that going forward we can accomplish those goals, but I'm incredibly sad that in 3 months we increased spending by $170 million. And we're really not very transparent about that with the voters. Thank you.
I have no further requests to speak.
Thanks. Any questions from the council? Councilmember Bowie?
Yes, Mr. Mayor, can I respond to those comments because it's a public hearing, right? I
Sure.
can comment on that, right?
Yeah.
Well, first of all, Mr. Matt Teller, thank you for expressing your concern, your frustration. It is noted, and if I was in your shoe, I'd give you my time volunteering for a good cause, and it's not going the way that you want it to be, and others members, I will feel frustrated, probably myself included. To ask some of the questions you asked earlier, that the report that was presented to your folks as well to us in February, I think that it's not also fair and right for us to respond to that, because the person that we rely on the information back then, it was the former finance director and former CM. Those are the numbers that was given to us as well. So some of the employees that's been here for a long period of time that did not get their raise, we made some of the decisions based on the report that we were given at that time. So me personally, I can't answer to those questions. Why is it that the report is not being transparent? Why is it after the new CM that's coming on board, those numbers start to surface that it's incorrect. I can't answer those questions. That will be those questions will be the former finance director and the CM. And if this body, council, and the public wish to call them on this podium and ask them those questions, I think we can do so. And ask them those questions, why are those numbers are different from what we see now when we got a new CM on the board. That would be more appropriate than us trying to explain to you, because we only make policies based on what was given to us. That's all. And that is why, since that incident, I made a request that we should form an ad hoc committee to oversee the finance department. And I'm so gracious that Mayor Pro Tem Kim Constantine and Council Member Glenn Grannis is willing to step up and be part of that committee to oversee the spending. So I appreciate your concern and those questions. Like I said, they're legitimate question. And also, is it David Cain or Evans? Mr. Evans, thank you for your comment as well. That's all. Thank you.
Thank you. I have some questions for David and Ryan. So first of all, I appreciate the first slide that kind of summarizes the $70 million variance. That makes it kind of easy for me to understand. Based on, kind of following up what Evan and Matt said, are we able to, I guess my question is, was the original forecast, were there errors in the original forecast that causing a variance now? Or, how much of it is the other forecast was bad, and how much of it is we made decisions to spend more money than we had in the forecast? And, do you understand what I'm saying? So was there, because we were surprised when the numbers came out as well, because we were, like Councilmember Bowie said, we made a decision. The forecasts that we were given, factoring in the salary changes, still showed a positive variance, and then we get the next report and it's changed a lot. So are you able to identify any kind of just maybe we just left out a percentage in the original was there any errors in the original forecast that you're able to identify, and can you sort of quantify how much of the change was due to decisions that we made? Does that make sense?
Yeah, I mean, we didn't see any errors. I haven't seen any major errors that happened. A lot of the change is from changing those baseline years and then hitting it with factors for the next 20 years can make big differences. The analogy I make is if you make a $5 million change now and just add that $5 million over 20 years, that becomes $100 million.
Okay.
So it's a bunch of small changes that will happen now that will lead to a large impact over time. So I don't think there was any errors in the numbers that I've seen.
Okay, but apparently the decisions we made had a larger impact than we were led to believe with the original forecast.
Again, neither one of us were here to be able to say, but yes, the changes that have been made do have the long-term impacts on the budget.
Okay, all right.
And I guess I would go back to the 21-22 where they made estimated revisions, and when you look at the final numbers, they're pretty close. So that original model had a lot of those budgeted numbers that got revised mid-year, but again, those were accurate numbers at the time.
Okay, Councilmember Vo.
Yeah, thank you, Mr. Mayor. Mr. David Cain, are you aware of the Calbert interest rate that was kind of credit to the city and the change in number in Calbert number?
I'm sorry,
The Calbert interest rate that factor into our unfunded pension liability.
what, going down to 6.8, you mean?
Correct. So many of our number is based on 6.8 interest rate that Calbert earned. And for the past year, that number went negative 6.5 or 6.8.
6.1.
6.1.
Yeah, and that goes back to Dan's example that he gave you on November 1st, where he talked about when CalPERS 2 years ago, was at a positive, 21.3, and then you go to a negative 6.1. And so he showed that difference, and that's part of the challenge that Ryan and I deal with, and he will continue to deal with in his career, is we're always trying to figure out what's CalPERS' next move. So part of the dropping to 6.8 is an outcome of a positive year of the 21.3%. And when that happens, they drop by 20 basis points automatically. And then you have the 6.1 loss. Now, they amortize it over time, but you still see it in those unfunded liability numbers that you referred to going, it's this amount, now it's this amount, and now it's this amount. So we're looking at each year's actuarial report, and keep in mind that the reports that we get are 2 years behind. So by the time we get caught up with what's currently happening out there, CalPERS is making other changes to their assumptions.
All right, so what was reported to us in November, and because of the interest change in 1 year, it went from positive to negative. Our unfunded pension liability went up from $50 million to $70 million. But okay, so the stock market since the beginning of the year, it has dropped down, but for the past 10 days, it's go up 10%. Mm-hmm. And many experts would believe that by the end of the year, it will go back to the level it was from the beginning of the year. And then we could get into the bear market for the next 5-10 years. So which means the interest rate will be more favorable to us. And those are the numbers that everyone have to work with. The city council have to work with, and the expert and the finance department have to work with. But we are dealing with a moving target. And
But wait a sec, that's all liability numbers. Those are all pension liability numbers.
Yeah.
That is not what we're talking about, which is the income and expense items.
Mhm.
That's separate from it.
Yeah.
So that's an additional burden that we have. But the 170 million and the 70 million, that is all income and expense items separate from the liability. So that's compounding the issue even more. You mind if I ask some questions? I'm sorry.
Go ahead, please.
I'm sorry, I didn't mean to interrupt you. So I want to pull my hair out up here, but a couple of things. So first off, you said it's okay to have negative numbers at the end. I don't agree with that. We need to plan for success, not plan for failure. I understand in the planning models, I'm a CPA, I have a master's degree in business, I understand that, but you don't plan to fail. You make sure that we build in whatever we have to get to those numbers. That's just the first thing. The second, when you take the $170 million of additional expenses and you take the $70 million of additional revenue that we're projecting now, and you break that out to 20, divided by 20, because it's over a 20-year period. So we're looking at additional expenses of $8.5 million per year, and we're looking at additional revenue of $3.8 million per year. And when the bottom line is we're about $4.85 million short per year, the bottom line. That's what we need to look at, and what we have to make sure that we figure out where to find $4.85 million, either in additional cuts or in additional revenues. That's the bottom line that we're going to be tasked with. I disagree, Matt, I love you, you know that, but unreasonable spending, a lot of it was to pay our employees what they deserve. That's what a lot of the money was. And quite candidly, we were spending a lot of money training and recruiting and all this stuff, and then we were losing all of our employees. The morale was down. Morale is much better at City Hall and amongst all of our employees. We're not losing employees at such a great rate anymore. Our police force, I believe, is fully staffed at this point. I think when I started, we were short 6 or 8 officers. We're down maybe 1, but we were short 6 or 8 officers. We don't have that issue, and quite candidly, our employees, damn it, they deserved the pay raise. They are the lowest paid in the county, and we did the right thing. So now what we have to do is we have to go find the revenue to help offset that cost. So that's important. Being on this finance committee, Maggie, get the meeting set. We have not. Okay, I saw you sent an email during the meeting, but I haven't read the email during the meeting. Let's get on top of this. I'm not satisfied with what happened between February and May. I'm sorry. There's no way that much of a change occurred. Maybe I'm wrong. You know, when you think about it by year, $8.5 million, it's much more understandable than just hearing, you know, $170 million. So that part, we need to get our arms around, and we need a better answer for HH. We need a better answer for our residents. And I commit that Mayor Pro Tem Constantine and I, along with all of the finance, but we'll figure this out. And if it's the answer is, that's what the answer is, then we'll say that's what the answer is and what we spent it on. Just looking at my notes here. The other thing with the additional funding, the excess funding that we did receive, we've talked about it, but I want to make sure I say it again that if we put it in the capital fund, which I hate that name because it's really not a capital fund, it's more of a retained earnings fund. I want a sublight item that says HH on it, and that we only spend those funds, even if it's under the capital campaign or capital fund, that it's spent in accordance with the spending pledge. That we don't spend it on anything else other than what we committed that we were going to do. So those are just my initial, I guess I don't really have a question on all this, just more of a frustration like everybody else. So I appreciate you guys diving into the numbers. I will ask that we, as part of the audit, what I asked for was an understanding of what happened, and I don't think that was asked of you guys. It's going to be asked. We want a deeper dive on what happened in those 3 months. So that's my points.
Yeah, Mr. Mayor, if I may, I know
Okay,
we ran out of time.
Councilmember Bowie?
I just want to make a comment to what you said. You asked earlier, Mayor, was there an error made? And you answered there was no error made. So if you said there was no error made, then are you saying our decision as a council body, we made those decisions, that's why we're negative 170? Is that what you're saying? Because to me, it doesn't. So if our decision we made, that's why we're negative 170 million. But based on the numbers and projection that we were presented with the decision we were made, we're fine. So something is not crisscrossing the road here. It's either the presentation that was presented to us is not accurate for us to make that decisions, or there's something wrong here. And I sure don't want this to repeat again. Because, like I said, we need to have probably a forensic audit, not just an audit, a forensic audit in it to find out exactly what went wrong. Because I don't want this to repeat again. I don't want any of this council to want this to repeat, because then we have a hard time to explain to the public what happened. Thank you.
Mr. Mayor.
Yes, Mayor Pro Tem Constantine?
Okay, so first of all, I totally agree with what Councilmember Granda said. We will take a deeper dive. It was my understanding the budgeted numbers for operating expenses were low and inaccurate for the last 2 budgets. It's a combination, Councilmember Bowie, also because of the rate increases were done, correct me if I'm wrong, on a percentage basis instead of a flat rate. That had a lot to do with part of this. Is that correct? Because that's what
I can provide a little bit clarification on that. So in our MOU for specialty pay, we had a flat rate, which is manageable. In the last negotiation, we revert back from a flat control rate to a percentage of 5% for specialty pay. So any changes in staff salary, that specialty pay 5% increases as the salary base increases as well. So, yes.
Okay, so my question is, why are they not aware of this? I mean, are you guys hearing this for the first time? I'm not trying to place blame. I'm trying to help everybody understand what's going on here.
Those numbers are included in the 8.3 million. That line item alone is $800,000.
Because as Councilmember Grandis did say, we need to really focus on February to May. That's where this went awry. And so we are committed to get to the bottom of this. Thank you.
All right, thank you. So, well, I know we're over time, but this is a really important issue, so I want to take what, the time that we need. I think that I appreciate Matt and Evan here and hearing your comments, and I understand your comments and your frustration, and we want to sort of get back on track with the Oversight Committee and the 20-year plan. I think the Joint City Council HH workshop is a great idea, as well as, and so maybe we can schedule it after the beginning of the year.
Yes.
And then are you guys planning on any additional work with regard to this at this time, or this is it?
Well, we are planning another HH meeting in December.
Okay.
I'm going to go into a little deeper dive in the numbers with them as well. And then as far as the 20-year plan, that's going to be ongoing forever. So we will continue to be updating that and presenting that to council and the HH committee.
So I guess the target would be February recommendation for the next official publishing.
Yeah, I think so, because that'll be after we have our official audited numbers.
Okay.
So we want to get those plugged into the model and then kind of take it from there, knowing that those are good, solid numbers, and then meeting after that with both groups.
Okay. Well, I appreciate, David, I appreciate kind of the recap of the sort of reminding us what HH is all about and the responsible spending pledge. And that was really, it's always good to remind the residents of why we did this in the first place. Mm-hmm. And so I appreciate that, and thank you for the presentation. Yep. Mayor Pro Tem
So
Constantine.
I have one more thing. David, when you were mentioning in taking a deeper dive into what you've done, you mentioned figures, I want to say between 100,000 and 300,000. You're kind of not able to fully match up and get the answers. My question is, do we have a substantial backup, I guess, not just numbers in the computer, but what, seriously speaking, what explanations there are for certain things? And if we don't, we need to, and I keep saying this. We can't just have numbers in the computer and people don't know what these numbers are for. There has to be some kind of backup or more information on it. Do we not agree on this?
So the numbers that I was referring to in the 21-22 budget year are actual numbers that are posted into the system as the revenue comes in, as the checks are written, as the invoices are processed and paid. What I was comparing in the 200,000 to 300,000 is the difference between the budgeted amount and the actual amount. So we're within 300,000
Okay.
on the revenue and the expenditures compared to the budget number that was provided. All of that detail is in the finance system. So one of my initial tasks was to say, hey, pull up the data out of the financial system. Let's look at the trial balance. Let's look at the revenues and the expenditures by account number, because you have them down to account number. You can see exactly what went where and how it was accounted for. So all of those numbers are in there and a part of that accounting system.
So the detail is good then?
Absolutely.
Perfect, thank you.
Mr. Mayor, just one last comment. So I feel for you two just a little bit here because neither one of you were here. The city manager's no longer here. The finance director's no longer here. And, you know, we're frustrated because, you know, we were assuming one thing. We made decisions based on that, and the outcome was not what we expected. So appreciate all the efforts you put in. Sorry you're taking all the heat. It's not you guys, but we do appreciate you.
Thank you.
And City Manager, Maggie, do you want to make a comment?
Yeah, I just want to add, you know, I did send an email to our Finance Ad Hoc Committee, so we're shooting for the week of November 28th, and that would be an opportunity for, oh, you're out of town? Okay, we'll figure out a date, but we can sit down and provide the revenue that we received so far from our sales tax consultant, and also provide the current actual and compare those information with our budgeted information. I want to provide some clarification on budgeted information. Staff prepares the budget beginning in March and April, and we present that data to City Council for their adoption in June, which is required that City Council adopt a budget by June 30th. And then that is the adopted budget that we projected, but throughout the year, there's adjustment that occur over that period due to gas increases. One of the items that we are presented before City Council for your consideration and adjustment. So those number changes, and then when we get the actual, that's why there's a $200,000 difference, which is not a big number in comparison. So I just want to go ahead and add that information. But the ad hoc committee will be able to work with our finance director and myself. And if there's any additional question, more explanation, we can share with committee and we can bring it back to City Council.
Okay, all right, thank you. All right, let's take a about a 5-minute break and we'll come